In San Francisco, and this is Bloomberg Technology. Coming up in the next hour, Amazon reporting third quarter results and shares reacting to a top line miss. But Jeff Bezos says the company is not slowing down. We will break down the numbers. Plus, Alphabet misses on revenue. Just how much have rising payouts to partners hurt Google in Wall Street's eyes? I talked to CFO Ruth Porat. Alphabet's problems don't end there. A bombshell report from the New York Times claims the company paid Android creator Andy Rubin millions to quietly go away after credible claims of sexual misconduct. But first, to our top story. Amazon has reported third quarter earnings, and investors are reacting to a top line miss. Shares declining in late trading. Amazon sales came in well under expectations at $56.6 billion, up 29%. At the same time last year, but operating income of $3.7 billion in the third quarter exceeds both the street's and Amazon's own guidance. Amazon's fourth quarter guidance is also a bit light. However, the company is guiding between 10 and 20% growth. Joining us now to discuss, Darren Baker, CEO of JumpShot, a market analyst company that tracks up to 5 billion clicks a day on over 100 million devices to deliver insights into online consumer behavior. Also with us, we have Jitendra Rawal of Bloomberg Intelligence, who covers Amazon for us as well. So, Jitendra, what happened here?
So if you look at the revenue miss, especially on the guidance side of things, it was a big number. The spending part, we were not worried about much because we expected spending pressure across the board. The wage hike issue was one of the uncertainties. From the business perspective, there are two areas where we see the weakness in terms of expectation. One is Whole Foods, the physical stores. You know, there's a sequential decline, and they were lapping a full quarter of Whole Foods acquisition for fourth quarter. So basically, that's one area where maybe the physical push is not growing as fast as we expected. And the second area is international growth in general. That slowed down materially. Now, they mentioned there was a change in the holiday season for India that sort of pushed out some sales. But with Forex headwinds, you know, that becomes a worry as well. So if you take those two things out of the equation and look at like AWS, the advertising division, they did fine. I mean, there was some slight growth rate decline in terms of like what they did last couple of quarters. But that's just law of large numbers. But based on what we are seeing so far, I think these are the two areas where we are worried.
We can assume fine is not acceptable for CEO Jeff Bezos. Darren, what do you make of this?
I think we're still seeing really strong growth. I don't think Jeff Bezos has anything to be worried about in areas like private label products, which Amazon is placing a big focus on. We saw that grow 22% year over year, and especially in some of those non-commodity products. Amazon Basics is their behemoth there that sells cell phone chargers and batteries and so forth. We saw 60% year over year growth in non-commodity Amazon private label products. We also saw huge growth in advertising revenue. I mean, up to 10% of all the product searches on Amazon now come from a sponsored search, and that's up from 3% in January of 2017. So there's huge room for growth.
Let's talk about that, because Alphabet and Facebook have dominated the digital ad market. Amazon is a distant third, but could at some point catch up. Jitendra, you'll hear what Ruth Porat had to say about this in the next segment. But can Amazon really get there?
So retail is a big segment for Google. It's the biggest vertical for them from an advertising perspective. And now we are seeing larger brands warming up to Amazon a lot more, given they've disclosed 100 million plus Prime members. So it's too big to ignore. So now what happens as sales shift, the ad dollars shift with it. And Amazon is targeting two buckets, right? One is the search bucket that Google has. The other is the trade promotions bucket. So they do get to sort of like benefit from that shift that's happening from bigger brands, and they can show the ROI, because you are advertising the product and you know exactly how much the sales were and things like that. So the targeting becomes much better. So that becomes an issue. So Google needs to sort of like go in the opposite direction over here. We saw their partnerships with Commerce, JD.com investment, and we think like Google should be more aggressive in e-commerce, and of course take the cloud stance a lot more aggressively when Amazon is encroaching on them from an advertising standpoint.
Meantime, we know that costs are going to go up. Amazon is increasing wages across the board. The company's also opening HQ2. They're going to be creating 50,000 new jobs. I mean, how are those costs going to impact coming quarters if we're in a state of fine? right now?
I think they still have a ton of room to grow and offset those costs. I mean, again, to piggyback off of what you were saying, over 50% of the product searches online now occur on Amazon rather than Google. Like the actual e-commerce product searches, which is the stuff that people want to pay for in sponsored search clicks. So I think as they invest in those kinds of tools and costs go up, they're going to see a much higher spike in the return that they get.
Jitendra, talk to us about what's happening globally. I mean, we know that there is a huge turf war happening in India in particular, but also other parts of the world.
Yeah, so that's one uncertainty that we are still yet to figure out, and obviously on the call, hopefully we get some guidance on that, is the tariff uncertainty causing some of this guidance to go down, right? Because there's a direct impact from a cross-border trade perspective. It's a smaller portion of their GMV, but there's an indirect impact from margins of third-party sellers and what it means for third-party sales growth and things like that. So we'll hopefully get more details on that, but that's definitely a concern.
The Amazon earnings call scheduled to start about 25 minutes from now. Darren, what do you want to hear?
I want to hear how the investments that they're making in their advertising platform are paying off. International growth, because I completely agree. I think there's a lot of room. There's a lot of room for opportunity there. There's also a lot of risk if they don't execute properly. And I'd love to hear more about how they're interacting with the rest of the ecosystem. I think both retailers and brands are probably very reticent about what's happening right now and very nervous. And I think they really need to figure out how to create a little bit more of an equilibrium like Google has done in that market.
We've got a holiday season coming up, increased postal rates, sparring with the president. How are the next few weeks? The next few weeks are critical for Amazon every year, but maybe this year in particular.
Yes, especially given the guidance. Now, the street is going to expect more than what they're guiding, given the holiday season demand, especially with so many more Prime members that they have right now versus what they had last year. I think where it boils down to is like, are they able to manage the cost in terms of scaling the capacity to deliver these products and sort of meet those numbers? Because we did see that created an issue back in 4Q15. And remember, Amazon always used to talk about profits as profits will ebb and flow. They were flowing, and now the guidance is suggesting there might be some ebb because wage hikes, the postal rates thing you talked about, and basically scaling logistics to support demand.
So, Darren, what do you think the headwinds are?
Headwinds.
Is regulatory headwinds?
I think there's probably regulatory headwinds, especially internationally. I think there's some brand and relationship headwinds, right? How are they going to, in these categories where they own 80+% of the online market share, there's going to be other competitors that come up, and there's going to be brands that just don't want to work with the behemoth. So I think that they're going to have a lot of those kind of headwinds too.
Do you think that the sparring with President Trump, Jeff Bezos' ownership of the Washington Post, could that be a real business risk for Amazon?
Yes, it's basically a compliance cost from a data perspective to sort of like what we've seen with Facebook and Google with respect to the fines that they're getting. So if there are some antitrust issues, which our antitrust analyst feels the risks are low, but they increase as you enter new markets. They increase as you get more data from third-party sellers and you sort of like commingle a lot more. So that is a real risk, but as from a probability standpoint, based on what our antitrust analysts feel, realistically, the probability is low at the moment.
More bark than bite. Jitendra Rawal, Bloomberg Intelligence, thanks so much. Darren Baker, Jump Shot, as always, great to have you here.
Thank you.
Well, it was a good day for semiconductors. Chip giant Intel blew away analysts and investors with its third quarter results, beating estimates with a positive forecast for revenue in the current quarter. Intel reported $19.2 billion in revenue compared to projections of $18.12 billion. The world's second biggest semiconductor also reported that revenue from its PC-centric business, its largest unit, rose 16%. This coming amidst a bad month for chip stocks as the Philadelphia Stock Exchange hit correction territory earlier this week. Coming up, Alphabet's third quarter numbers are in, and it's a miss in revenue. That is, I spoke to Alphabet CFO Ruth Porat about just what kept those figures down. That is next. And if you like Bloomberg News, check us out on the radio. Listen on the Bloomberg app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. Okay. Alphabet shares slumping after hours after reporting its third quarter results. Shares had fallen by as much as 7% on news that Google's parent missed on revenue, squeezed by payouts to partners for distributing its money-making search engine and web browser. Let's get straight to it with Scott Kessler, CFRA's Director of Equity Research in New York. We've also got Technalysis Research President Bob O'Donnell with me here in the studio. Scott, I'll start with you. Look, I just got off the phone with Alphabet CFO Ruth Porat, who is now on the earnings call with CEO Sundar Pichai. She talked about hardware and AI and cloud and mobile and global, all of that buoying the results, and then mentioned that FX headwinds were probably the reason for some of the weakness that we're seeing. What do you see?
So thanks a lot for having me, Emily. I guess what I would start with is, look, I don't think it's a coincidence that you see a lot of these big cap technology and communication services companies missing on the revenue line. And I think a lot of that, frankly, is due to currency, where the dollar strengthened pretty significantly over the course of the quarter. And look, I think when you look at the miss, I mean, it was by a hair. And granted, it was a miss, but it was really a very, very small miss. And if you round, like a lot of people do, it really wasn't a miss. So the way we look at it is it was a good quarter. It's amazing to me also how very few people seem to also be focusing on the earnings beat, which was substantial, aided by a lower tax rate, for example. But overall, I think this was a solid quarter, above 20% growth again. And it seems like the trends are intact for the company to be successful for a number of quarters to come.
That said, there is concern about Amazon, distantly on Google and Facebook's tail when it comes to digital advertising. I asked Ruth Porat if she thinks of Amazon as a threat. She said, whenever new inventory is created that attracts consumer interest, advertisers will be interested. From what we're seeing, though, many dollars are coming from trade promotion and other budgets that haven't historically been spent on digital advertising. So we believe this expands the opportunity to tap into digital ad budgets. Bob, do you buy that?
Well, sure. I mean, I think that makes a lot of sense in terms of where they're trying to go, especially with all the things they're doing around YouTube and other content that they're bringing available. The other thing I think, and she mentioned it briefly, is some of their R&D costs were also higher. They've got a lot of investments in hardware. They've got a lot of investments in some of their YouTube services, the YouTube TV, for example. And I think those are interesting opportunities moving forward. At the end of the day, look, it's getting expensive to get to the right people and to get to these services out. Hence, these acquisition costs are going up, and that is an issue. But like the other gentleman said, it's essentially it hit it, but just barely missed. And the opportunities moving forward for them are still very strong. The concern, of course, is the regulatory environment. What's going to happen there? There's a lot of clouds hanging over Google/Alphabet, and I think those are concerns that people are thinking about, and we have to think about long term.
Let's talk about some of those clouds: privacy, fake news, being called to testify before Congress, not showing up. All of these things are very concerning, and I asked her if these privacy concerns were having an impact on users, having an impact on advertising, and she didn't really answer that question. I also asked about China and Google's reported plans to reignite its search engine in China. She told me at this point we continue to invest to help and support Chinese users from developing Android through mobile apps like Google Translate. As Sundar has said repeatedly, we are not close to launching a search product in China, and given the sheer scale of the market, we are focused on making sure we are doing the right things for the long term. Scott, what do you make of that?
So the way we've thought about this is, while it would be great in a number of respects, at least from an operational and financial perspective, for Google to re-enter China, the reality is, especially given the growing tensions between the two countries and their governments, we see that as a long shot, particularly over the near to intermediate term. It's actually one of the reasons why just over the last day or two we upgraded shares of Baidu, because we think that has been an overhang for that company and its stock, and we don't think that really is viable at this point for Google to re-enter China. I think they have far more priorities elsewhere, and I think just the political pressure and complexity and costs and risk of failure are so substantial. I think, look, continuing to invest in what's been working and things like Waymo, that's the way that that Google and Alphabet should be investing right now.
Do you think that Google should have not dropped Project Maven and continued its work with the DoD? I did ask Ruth Porat about that, and she, talked about how they believe it's important to continue working with the military and laid out all of the other ways that they are doing so. But when you talk to Amazon, Jeff Bezos and Microsoft Satya Nadella, they're saying, look, our country needs to be defended. So yes, we are going to work with the government and the Department of Defense.
Yeah, so my opinion on that is I think that they should have continued to talk with the government about that contract. I mean, you're talking, I think, about a $10 billion opportunity, which would have been tremendous for Google and its cloud business, which they've been investing in, but that would really possibly have been a game changer. And I'm not really clear on exactly what the opposition was in terms of moving forward with that contract. And you point out some very good rationales that other companies have articulated. So no, I think that actually was a mistake to walk away from that contract, particularly at this stage.
Bob, Google's also got some business being done in Europe. They are facing that $5 billion record fine for antitrust issues, and she for the Android issues, I should say. She talked about how it remains to be seen how that will play out, but how much do you think that's going to hurt them?
I don't think it's going to hurt them very much financially, because the truth is there are very few alternatives, and ironically, in some ways, Google could actually make more money, because now the phone makers are going to have to pay Google for services they essentially gave away, because they have to be offered as an alternative. So in a weird way, I think it actually helped them. But long term, the financial impact, I think, is really small. And most of these controversies, I think, in the near term are not going to have a big influence on them. The bigger question are, as GDPR gets enforced, as the U.S. develops whatever equivalent it's going to create, as other countries around the world do this, how does that fundamentally impact the business model of what Google does around customized advertising and personal data tracking? Again, none of these things are going to impact right away, but certainly longer term, I think those are issues that have to be addressed.
All right, Bob O'Donnell, Technalysis, Scott Kessler, CFRA. Scott, thanks. Wait, before you go, Scott, I want to ask you, you just downgraded Twitter. Why?
I did. You know what? The results were good in a lot of respects. The 29% revenue growth and the margin expansion were encouraging. But the reality is, notwithstanding some of the reasons, we saw MAUs decline sequentially. We saw a deceleration in DAUs. We see a premium valuation, and we see a lot of competition. And the reality is that the stock, notwithstanding the recent decline, is really overvalued right here. So we have a 12-month target price of $27, and we've been negative and positive on Twitter over the years. This, we think, is really the time to be more skeptical rather than optimistic.
All right, glad we got you on the record about that. Scott Kessler, CFRA. I do speak with Ned Siegel, Twitter's CFO. You'll hear that conversation later in the show. Coming up, Alphabet earnings come amid scandal. How the tech giant's employees are responding to rumors of executive sexual misconduct. And at Bloomberg Technology, live streaming on Twitter. You can check us out at Technology. And be sure to follow our global breaking news network, TikTok, on Twitter. This is Bloomberg. As we mentioned earlier, Alphabet reported its third quarter earnings where the company beat estimates but missed on revenue. This coming amidst a bombshell report by the New York Times saying Google gave Android creator Andy Rubin a massive payout package despite credible allegations of sexual misconduct. A $90 million payout, in fact, to leave after he allegedly coerced a subordinate into a sexual act. Then Google kept it quiet. A representative for Rubin has denied the claims to Bloomberg and said Google has said that 48 people have been fired for sexual harassment in recent years and that no one got an exit package. I want to bring in Liz Fong-Jones, an engineer at Alphabet, who's been increasingly vocal about how her current employer is handling harassment and discrimination. Liz, thank you so much for joining us today. You've been very dialed into these issues. What's your reaction to this report? Is this anything that you could have foreseen?
I'm frankly not surprised. What I'm surprised about is that this has finally come to light. There have been rumors for many, many years that directors and above at Google have been shielded from complaints about their sexual harassment and behavior at work. And now to see that there may be some consequences is heartening.
Now, Sundar Pichai sent an email to staff today saying in recent years we've made a number of changes, including taking an increasingly hard line on inappropriate conduct by people in positions of authority. I just got off the phone with Alphabet CFO Ruth Porat, who said she's super proud of how committed Google is to these issues today and what is being done, the key word being today. Do you think Google has this figured out?
I don't think that Google has figured out in terms of fixing the culture of distrust between employees and HR, in particular the employee relations team that handles investigations.
What are employees saying right now inside?
I think that many employees that aren't women are shocked. But many of us who have been following these issues for a while are merely still frustrated with the state of the company and frustrated that we can't get our complaints about harassment taken seriously.
Now, I understand you take a risk when you come on the show. You still work at Alphabet. You've been on the show before and you've spoken out about this. Has anyone ever discouraged you from speaking out about this? Have you had any talks with your bosses about, the decision that you've made to be more open about what's happening on the inside?
I'm a relatively high-profile employee. It would be very challenging for them to discriminate against me or retaliate against me. Therefore, I feel like I'm in an okay position to speak out on behalf of the people that don't necessarily have that power. A lot of what happens at Alphabet depends upon your own management chain. There's a lot of power in your own set of managers. And if they are able to cover you, then that provides you with a significant amount of leeway. If they're not, then they're going to look for excuses to push you out. If you look at what happened to Tim Chevalier, for instance, he spoke out. He was fired because his bosses felt like they didn't value his contributions enough and he wasn't worth keeping around.
What do you think needs to be done, Liz?
I think that it is surprising that David Drummond, the chief legal officer, still works at Alphabet in light of the fact that he violated the company's policy in getting into a relationship with someone who worked for him, right? And if that's the example being set from the top, how can we get any credibility for the fact that HR is able to investigate and deal with anyone, right? If the chief legal officer is untouchable.
Do you want to hear from Larry Page?
Sorry, what?
Do you want it quickly, yes or no? Do you want to hear from Larry Page?
Yeah.
All right, Liz Fong-Jones of Alphabet, thank you so much for stopping by. Great to have your views here today. Coming up, is the online marketplace reaching a saturation point in the U.S.? Amazon third quarter results point to yes. More details ahead. This is Bloomberg. I'm Emily Chang in San Francisco. Amazon reported sales that missed analyst estimates and projected lower revenue in the busy holiday quarter. The report could be suggesting the online marketplace may be reaching a saturation point in the U.S. The company showed slowing revenue growth in all categories quarter over quarter, including online sales and subscription sales, Amazon Web Services sales, and its fast-growing ad business. Revenue climbed 29%, down from 39% growth last quarter, and missing analyst estimates. Still, we should point out that Amazon shares are still up 50% this year. Digital ad veteran Bobby Figueroa left his job at Amazon in January to start his new company. He is now the CEO of Gradient.io, which helps brands advertise on Amazon. He joins us now from Seattle. Also with me here in San Francisco, our Bloomberg Tech Senior Executive Editor, Brad Stone. So, is there a saturation in the market right now?
No, I don't think so. I mean, let's put it in context. Amazon shares were up 7% today during the market, and then they just gave it back after the earnings. Margins were strong. Amazon missed a little bit on the top line, although it beat on profit. That fourth quarter guidance was weak, so analysts I think investors are a little worried about that. But Amazon is often kind of conservative, and in terms of the segment slowdown, it's kind of the law of large numbers. Some of these categories like AWS and advertising are growing at three-figure rates, or in AWS's case, around 50%. So it's not a surprise they'd come down slightly.
Bobby, you have unique insights from the inside, and now working with Amazon from the outside. I mean, is there something bigger here to be concerned about a broader slowdown?
Not at all. The advertising business, which is where I've had my experience, it's a very, very large market, and particularly the digital point of purchase, which is a $225 billion industry, is really, really large, and every single brand should be thinking about that as their #1 priority for driving presence online.
Now, let's talk about this because, Amazon is a distant third behind Google and Facebook in the digital ad market, but encroaching on their territory. Is Amazon a real threat to Google and Facebook, and if so, when?
I don't believe there is really going to be a lot of shifting between all of those players. What we are entering now is a completely new era of digital marketing. It's that marketing about pointing customers to brands where they're ready to make the purchase. And that's where brands historically have spent billions of dollars in making sure that they have the right presence at the point of sale, they have the right amount of product at their shelves, and they did that for decades at traditional retail. Now, with a platform like Amazon, brands need to start shifting to do the same kind of investment to make sure that they're winning customers at that point of sale. It's different from making sure that they're driving their awareness and consideration, which is what typically other platforms do. So I do believe that this is an opportunity for all the different platforms to continue to grow very aggressively.
Well, that sort of echoes, Brad, what Ruth Porat told me, which was that actually the money that's being spent on Amazon, she believes is coming from different ad budgets that weren't going to digital ads before, like trade groups and the like. Would you echo that?
Well, I mean, what's so smart about what Bobby helped to create at Amazon is the fact that, not only can advertisers find customers right at the point of sale, right as they're about to buy, but then Amazon can turn around and tell advertisers if the advertisement has resulted in a sale, if they went and they clicked. And so, not a lot of other websites or retail locations can do that. I recently went and put in a search for a refrigerator, and right at the top there's Kenmore. So somehow Sears lives. But every brand either wants to be in that top spot or doesn't want to not be there because they're worried their competitor might be there.
So, Bobby, your company just raised $3.5 million. Clearly, you see an opportunity to leave Amazon. How big do you think that opportunity is?
I think there's a tremendous opportunity. Like Brad mentioned, there's brands that are competing for being present at that point of sale. Customers tend to buy the products that they find, and what we're building at Grading.io is really machine learning that helps take all the information to optimize that presence for the brands. There is not one person that you can go talk to secure that placement, to secure that presence when you're working with Amazon, as you did with traditional physical retail stores. So it's really the work of machines and algorithms that will help brands be successful in this new area. And that's the opportunity that I saw in building our company at Grading.io.
Brad, walk us through some of the other strands here. Whole Foods, Amazon Prime, Prime Video.
Well, for the first time, the revenues from the physical stores was down slightly from the previous quarter. And so, for Whole Foods, I think they've got some stuff to figure out in the stores. What that category doesn't show is how Whole Foods is driving online shipment of groceries for Amazon. So there are about 60 cities now, including here in San Francisco, where you can order online from Whole Foods and have it delivered. So Whole Foods is paying off in other ways, but physical store slowdown in revenue. It's curious because obviously they've been adding bookstores and Amazon Go stores. Prime, the CFO talked a little bit about how they were changing how they organize some of the revenue from Prime. I won't get into it. They're amortizing it differently. They're saying that's spreading out the subscription revenue more evenly throughout the year. It used to be weighted more towards the back half of the year. As with all these things, it's hard to make sense of the numbers right away. But clearly the law of large numbers is kicking in for Amazon.
Now, Bobby, obviously holiday season coming up, which is always huge for Amazon. What are some new trends you're going to be watching for and that we're going to be seeing when it comes to what Amazon is showing us, advertising and consumer behavior?
Well, Q4 is definitely a very important season for every single brand. as more and more of the purchases are moving to online, I think brands need to be very constant. They need to be trained and need the new tools to be able to take advantage of those trends. What's been really interesting is to see a lot of the new direct-to-consumer brands really utilizing platforms like Amazon to start encroaching in incumbent brands. And they're doing it because it's the platform and the algorithms and the ability to use tools and platforms like what we're developing to help them drive those sales. So I would say you need to embrace the tools, need to embrace technology, you need to learn about what this digital point-of-sale marketing is all about to be able to take advantage of that huge surge that's happening in Q4.
Brad, will it be another happy holiday for Amazon?
I mean, look, Amazon's 3 or 4% of overall retail in the U.S. There's such a long runway. And so, yeah, I mean, I think that all the kind of tailwinds are working on Amazon's behalf.
All right, Brad Stone, Senior Executive Editor for Bloomberg Tech. Thanks so much. Bobby Figueroa, Gradient.io, CEO as well. Thanks so much for stopping by. Still ahead, it looks like Snapchat is on the decline. Snap just reported the number of daily users fell for a second consecutive quarter. We will break it all down ahead. Meantime, Alphabet's call just wrapped. CFO Ruth Porat spoke about the state of global business. Take a listen.
We actually feel pretty good about the strength globally, which I noted in opening comments. Across the board, 20% growth in the U.S. on a $15 billion base. Sundar noted what's going on in APAC, 30% year-on-year growth. It's now over a $5 billion revenue business, and we've had sustained quarter after quarter growth at this, kind of 30-ish% area. Feel really good about that.
Twitter surged the most in 8 months following its third quarter results as sales blew past forecasts. Despite the strong financial numbers, however, monthly average users decreased by 9 million from the second quarter. That means the social network now averages 326 million MAUs this coming as Twitter continues to purge fake accounts from its platform. I sat down with CFO Ned Siegel to talk about third quarter results.
We're challenging a ton more than we used to. So the 9 million number is something Jack talked about in front of Congress back in September. We have become more sophisticated in our understanding of how people create spammy and suspicious accounts so that we can detect and prevent their creation or stop them after they've been created. How many get through really depends on how many of them should get through. We test far more accounts than are spammy and suspicious, and that helps us understand the behavior, because just because an account is created on a web browser in a certain country with a certain IP address doesn't necessarily mean that it shouldn't be on the platform the way that another one might. So there's a lot that goes into it.
Now, as a result of this, you've said monthly active users will continue to decline. How much further will they decline?
So we said that MAU would decline in the mid-single-digit millions in the fourth quarter because of GDPR, our ongoing health work, and decisions we might make around SMS contracts that we have with carriers. We don't forecast MAU when we go out further than a quarter. We've done it each of the last 2 quarters because we could see a decline coming, and we wanted to share it with people. When we step back and think about our health work more broadly, we don't want to be constrained by the disclosed metrics. We want to prioritize health above all else because we know that it's a critical growth vector for the company to make sure that Twitter is a safe place for you and me and for the people who should be on the platform, and that we're moving spammy and suspicious behavior whenever we can. Sometimes it affects the disclosed metrics. Other times, such as in the second quarter when we removed tens of millions of accounts and they were largely inactive, it doesn't affect the disclosed metrics as much.
So let's talk about the health. Yesterday we saw tweets promoting fake bomb scare, fake bombs, hashtags filled with conspiracy theories. How is this still happening?
Well, we still have work to do to improve the health of the conversation on Twitter. There are so many ways for us to address these challenges as people get more sophisticated in how they create the bad behavior on Twitter. One of the great things about Twitter that we're able to benefit from is because it is public and open and real time, we often find things, but often things are corrected by the platform itself, by other people on Twitter who say, that's not true. Or you may believe that, but I believe something different, and I want to tell you what I believe. The fact that the platform's open really makes it different and allows us to take a different approach around policies and enforcement than others may.
We are in a period of extremely divisive politics. Just this morning, the president tweeted, "A very big part of the anger we see today in our society is caused by the purposely false and inaccurate reporting of the mainstream media that I refer to as fake news. It has gotten so bad and hateful that it is beyond description. Mainstream media must clean up its act fast." You know, I know in the past you've said the president is a newsmaker, he's an influential person, and yet I wonder, is the president getting a pass from Twitter when it comes to what is true and what is false, what is hateful and what is not, what incites violence and what does not, because he is the president? So
I'll just go back to what I mentioned before about Twitter being public and open and real time. Those are things that allow people to see what a public figure is going to say, regardless of their party affiliation, regardless of where they are in the world. They can learn from it, they can respond to it, they can observe how others might respond to it, and we believe that that allows for a healthy public conversation, that allows people to have more information than they otherwise might, whether it's something here in the United States or it's around the Brazilian or Mexican elections, which were just completed. It's an important part of our purpose is to serve a public conversation, which means for people to be able to see what other people are saying.
Twitter has been very clear about the need to do more. Jack Dorsey has been clear about this. How many more people are you hiring? How many more people are you dedicating to this particular problem?
Health is our #1 priority. We think about health, growing audience, improving our revenue products, and sales as our biggest priorities. I don't expect those to change much as we move into next year, and I think because Twitter is public, open, and real-time in nature, we're able to leverage those characteristics and still accomplish a lot through our Twitter services team, through the machine learning that we use to amplify our policies and the Twitter services team.
Are you actually going to add more people?
Well, we've been adding more people, so we're going to grow headcount about 15% this year as we continue to invest against all of our priorities. And I would expect us to continue to grow headcount, but it's not against any one priority, it's against all of those priorities to really be able to grow the business and execute against the opportunities that we see.
Twitter CFO Ned Siegel there. Joining us now to discuss, eMarketer Principal Analyst Deborah Aho Williamson and Bloomberg Tech's own Selena Wang. Deborah, I'll start with you. So, what do you make of these numbers? Advertisers are obviously coming back, spending more, but monthly active users keep going down. And in some ways, it can be difficult to see the progress, even though Twitter says we are challenging millions of accounts every week.
Yeah, absolutely. Ned Siegel just talked a lot about health. And my viewpoint is that if you're going to get healthy, you're going to need to lose some weight. And in the case of Twitter, losing the weight is in losing a few million users. And overall, I think that is a positive step. I think Twitter's focus on the daily active user number is something that's important and needs to be done. And I think that the steps that Twitter's taken to make its ad products better, to reprove itself to advertisers, are starting to pay off. So once this weight loss has gotten done, hopefully we'll see users rejuvenate again, and then we'll see advertisers come right along.
Selena, Twitter doesn't report daily active users, and you do wonder why.
Absolutely. The fact that they don't report it means that there's something they're not quite comfortable with. Now, Ned Siegel did repeat a few times on the conference call that the DAU is well below half of what the MAU is, so there's a lot of room for growth. Something that was a little bit concerning in this quarter is that DAU actually went single digits for the first time in several consecutive quarters of double-digit growth. So that means that their healthy cleanup efforts, the reduction of spam, is actually hitting their daily active users, and that's the number that really matters. That's the number that really matters to advertisers and is showing true engagement. So at some point, they need to show that these cleanup efforts are not just going to be able to let them monetize better, but are actually going to draw more users to the platform.
Right, and that's the question, is whether they will, right? I mean, certainly, Deborah, the cleanup efforts are incredibly important. Twitter, and what's happening on Twitter is driving the national and international conversation. But, once Twitter gets its act together, are they actually going to add a significant number of new users, or is this the size of Twitter? Some 300 million users, is this it?
It's hard to say whether this is it or not, but I think what we're seeing now, though, is Twitter finally coming to terms with what it really is. It's not a social network that's going to be the size of Instagram or Facebook. It's a platform for real-time news and engagement. And to the extent that it can continue to promote that uniqueness from the other social platforms, I think that will draw users back. I think that that this constant back and forth of how many people does Twitter have, they just need to embrace what they are. And if it's 300 million, if it's 400 million, whatever it ends up being, if Twitter embraces what it is, then advertisers are going to embrace that as well.
Selena, would Twitter accept that it's never going to be the size of Instagram or Facebook at this point?
I think Jack Dorsey is a lot more focused on making a better experience for the users that they have. I don't think he's trying to get to 1 billion plus users like Facebook. And just echoing that earlier point, I think investors are coming to terms with the fact that this platform may never be more than a few 100 million users. But clearly, because of the huge stock jump, they're happy with the fact that they're able to monetize and get more money out of the same base of users. And the fact that MAUs went down didn't impact the revenue and profits they were able to make because they're able to better target for advertisers, deliver a better return on their investments. And Twitter is starting to offer something that Snapchat and Facebook's and other competitors can't. And it's really that real lifetime conversation and a place for them to launch new products, generate conversation among the base of users.
Right, and have to reiterate, shares closed up more than 15% today. Also, shares up over 40% over the course of the year. I do want to talk about Snap. Snap reported its third quarter numbers Thursday, and all eyes were on user growth. The social media company reporting that the number of daily users fell for a second consecutive quarter to 186 million, almost exactly in line with analyst estimates. The company forecast this trend will continue into the current quarter and gave a weaker than expected revenue forecast of $355 million. This coming as Snap struggles to fend off Facebook's Instagram, whose story feature has become the preferred app for millennials, according to a recent study by Piper Jaffray. Deborah, can Snap reverse the trend?
Yep, that's a big question. And you know, honestly, both Snapchat and Twitter are in a similar position in many ways. They both seen user declines this quarter, however, better than expected revenue. So that's a positive thing. Again, I think similar to Twitter, we've got a situation with Snapchat where its daily active users, in the case of Twitter, is monthly active users, but in the case of Snapchat, daily active users have declined yet again for another quarter. This is definitely concerning to advertisers. And the fact that Snapchat has been able to monetize those users to a better than expected extent is good, but that's probably not going to continue forever. I think that we're going to have to see Snapchat do more to restart that user growth. And honestly, one of those things could be the Android app. Yeah, one of those things could be finally figuring out Android. The Android app has been a thorn in Snapchat's side for a long time now. I think once Snapchat figures that out and relaunches a solid, well-performing Android app, they're going to get naturally more users who use Android phones, especially in markets outside of the United States where Android is really popular. So hopefully they'll figure that out. Remains to be seen how quickly, but hopefully they'll figure it out.
Well, it is kind of astounding that, you know, this many years into its existence that Snap hasn't figured out Android, which is the biggest mobile operating system in the world. Why haven't they been able to do this?
That's unfortunately not something that I know I can comment specifically on. I don't know the inner workings of the Android issue that they've had, except that to agree with you, you're absolutely right. This is something that needed to get fixed a long time ago. Hopefully it'll work miracles for them when and if they do get it fixed.
All right, Deborah Aho-Williamson of eMarketer and our own Selena Wang, thank you both for weighing in, Twitter and Snap. Coming up, it was a wild day, to say the least, in tech earnings. We wrap up all the news surrounding Alphabet, Amazon, Intel, and more. That's next. This is Bloomberg.